Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Morning, everyone. It's Jim here. Welcome to our second Easter live revision for A-Level Business. And look who's joined me.
Screen. So let's start with some MCQs. So we've got a business sells its only product. That's handy for £24 per unit. The variable costs is 2/5 of the selling price. Remember, fractions is quantitative skill 1, ratios, averages, and fractions. What is the monthly contribution if 10,000 units are sold each month? So we've got one product, £24 per unit. We've got the variable cost per unit, which is 2/5 of the selling price. From that, you can work out the variable cost per unit and therefore the contribution per unit. Can you work out the monthly contribution? Now, as we discussed yesterday, whenever you get a calculation question, we're looking for 3 things: formula, process, final answer. That's because in every calculation question, you've got marks for knowledge and marks for application. Therefore, every step in the calculation attracts some marks. So even if you get the final answer wrong, you can get the correct answer. If you don't know the formula, write a definition. Chances are you will get some knowledge marks for that definition. So lots of answers coming in now.
Yep.
The majority, I think, are going for B. Let's reveal the answer.
Right to me.
It is indeed B. So 2/5 is 40%. So the variable costs are 40% of the £24, which is £9.60. So the selling price per unit minus the £9.60, so the £24 minus the £9.60 gives us a contribution per unit of £14.40. Multiply that by 10,000, gives you 144,000. And so anonymous there, and a couple of comments saying, I forgot to do this and I forgot to do that. That's absolutely fine as long as you've shown your process. If you just write the wrong answer down, no marks. If you write the wrong answer down, but there's some correct steps in your process, you will get marks. So leave nothing blank. Have a go at everything. Well done, everyone. Shall we have a look at the next MCQ?
You do this one, G.
So-
I'll do the next two.
Okay, on a break-even chart, the break-even output is shown as the point where. Is it A? Is it B? Is it C? Is it D? Now, break-even charts have appeared in the AQA paper. I've yet to see a break-even chart in the Edexcel A-level business paper, part paper 1, paper 2, paper 3. So just make sure you are familiar with break-even charts. So on a break-even chart, the break-even output is shown as the point where. Is it A, the total revenue line intersects with the total cost line? Is it the total cost line is at its lowest? The total revenue line is at its highest? And the total profit line intersects with a horizontal axis. So I think we've got A, B, C, and D there. I think the majority are going for A. Shall we find out? That is the correct answer. Well done, everyone. And bonus question now, just quickly type in the chat window. What is illustrated on a break-even chart by a straight horizontal line? So there'll be a straight horizontal line on a break-even chart. What is that? Could we identify what that is? What do we think? So if you've got a straight line on a break-even chart, what do we think it is? Dean Smith, fixed costs. Yes, well done, everyone. Fixed costs. But you'll be amazed at how many students get that mixed up on break-even questions. Well done, everyone. So the answer to that was A. Fixed costs is indeed a straight line on a break-even chart. Jim.
Yeah, good stuff. Question 3, and this is like an applied break-even question. So business A, where do we come up with these names? Business A imports food and drink products from Europe and sells them to restaurants in the UK. So imagine them importing bottles of wine or packets of pasta. Which of the following would decrease the break-even output of the business? So 4 situations there. Is it A, a new tax on importing the products from Europe to the UK? Could it be B, a fall in the number of restaurant customers buying from business A? C, an increase in the rent paid on the warehouse used by business A? Or could it be D, a decrease in the cost of shipping the products from Europe to the UK? So 4 situations there. So it's quite an interesting question, this one. It's break even, but it also introduces some other topics, doesn't it? Such as taxes, protectionism, free trade. What do we think? A few more seconds. Lots of people have worked this one out pretty quickly, which I think, G, is really encouraging. Most people going for D. Should we have a look? It is indeed, yeah, D, isn't it? All the other 3, well, actually, B has no impact on the break-even output. B, a fall in the number of customers. That's likely to affect actual output, isn't it? Which would affect the margin of safety. A and C would both increase the break-even output. C is an example of an increase in fixed costs. A would be an example of an increase in variable cost per unit, whereas D would reduce the variable cost per unit. And Adam's saying, would this increase the margin of safety? Do you mean no? You mean B? In theory, B reduces the margin of safety, doesn't it? Because it should reduce the actual output. The break-even output won't be changed. And last one of these, business A. Well, back to business A again. And business A has decided to change its business from importing, and it's now operating a car valeting service. So the business estimates that its price elasticity of demand is minus 1.6. That should say, it does say minus 1.6, but the minus is appeared on the second line. So it's minus 1.6. Which of the following will be most likely to increase the margin of safety? So don't forget, the margin of safety is a difference between actual output and break-even output. So is it A, an increase in the cost of cleaning materials? Could it be a decrease in the selling price of the most popular valeting options? Might that impact margin of safety? An increase? Could it be C, an increase in the rent paid? Or is it D, new, cheaper car valeting competitors operating nearby? That's a good question, that one. Good question. But looks like most people are going for the same option. Those who are having go in the live chat are saying B. Let's have a look, shall we? Oh, yeah, it is B. Well done. Yeah. So B, we're told the we're told it has an elastic demand, doesn't it? Its demand is very sensitive to changes in price. So, for example, a decrease in the selling price, let's say of 10% in the selling price of its most popular valeting options, should increase demand by 16%, shouldn't it? Because the PED is minus 1.6. So that would definitely increase the margin of safety. The break-even output would fall slightly, but the actual output would increase by more. Therefore, the margin of safety will get bigger. Superb stuff. Did I ever tell you, Graham, that I've been recently making a new bicycle out of spare parts from car washing machines?
Really?
Yeah, I thought we might go out later, take it out for a spin.
Hey.
Over to you, mate.
So, a quick calculation countdown question here. So, we got a business which has monthly fixed costs of £420,000. It currently produces 8,000 units per month. That's its actual output. It has a margin of safety of 2,000 units per month. Based on this data, what is the current contribution per unit? Now, I'm really hoping that we've got the Disney princess music here. I'm hoping we have. So we're going to soon find out. So you have 60 seconds or a minute to type your answer into the chat window.
So the music's gone on strike as well, mate.
Yeah, I think this is a karaoke version. They do say silence is golden, though, don't they?
Yep. It won't stop our student audience getting the right answer, though. Lots of answers coming in.
No. Now, I've not seen.
not
Yeah,
yet.
there is some correct answers coming through now. Now, just before I reveal the or we reveal the correct answer, just a couple of points here is that lots of people putting answers in. Now, obviously, we expect a pound sign in front of these, and if this was an exam question and you didn't put a pound sign in front, you would lose a mark for that. And it's these little marks, what we call around the margins, that can make a huge difference. So if this was, say, a 4-mark calculation question and you put the right answer but without the pound sign, you're only going to get 3 marks. And if you extrapolate that over your 3 papers, you could lose 20 marks easily. So the answer is indeed, it is £70 per unit. So again, look at what we said today and yesterday. Formula, process, answer. So we've got the formula for the margin of safety, which is actual output less the break-even output, which gives us a break-even output of 6,000 units. We know that because the business produces 8,000 units and its margin of safety is 2,000. So break-even must be 6,000 units. We know the break-even formula, fixed costs divided by contribution per unit. And therefore, the fixed costs divided by the 6,000 units gives us £70 per unit. Now, just before we move on, just 2 more things I really wanted you to pick up on is that if you get a break-even calculation question and it comes out as a decimal, you must round that up. Otherwise, you will lose a mark for that as well. There was a question 4 years ago where students had to calculate the margin of safety. The break-even amount came out as a decimal. Students who didn't round that up therefore got the margin of safety wrong. We deducted a mark for that. So you must round break even up. Also, just some of the language on that MCQ about demand being elastic. Be really specific. It's price elastic or income elastic. So try and avoid saying in your answer, demand is elastic. Be really specific. Say it's price elastic or say it's income elastic. Those words do make a difference because that way you're showing more accurate knowledge and understanding. How do you round up? Well, it's quite simple. If the break-even if the break-even came out at, say, 170.6, then you round that up to 170, 171. If it came out at 170.1, you would still round that up because you can't break even at a decimal. You can only break even when the next whole unit is sold. So you would always round up in every circumstance. Always round up. Always.
Yeah.
Okay, shall we move
Yeah.
on to the application spinner?
Yeah, we've got two of these, G. So this is our last break even activity. Shall I do the first one? Then you do the next one.
Yes. Okay.
So we've got 6 businesses there, and helpfully we've also described what they do. And so we've got a fashion retailer, ASOS, Pure Gym from the fitness market, obviously Jaguar Land Rover, we mentioned right at the start of this session, despite the technical gremlins, Just Eat, Uber, and Sky. And all we need to do is, the question is, explain how this business could lower its break-even output. So we're looking for just a line in the live chat. We'll try and put one to you on screen as well. An explanation as to how the specific business could lower break-even output, and ideally use some such as seasoning or some application that helps root your answer in the business. Let's spin the wheel. What do you think it's going to land on, Graham?
I don't know,
Don't
so
wait too long.
exciting. I do think Uber.
Well, you're wrong. It's JLR, but that's useful for Edexcel students. Obviously, with paper 3. So over to you in the live chat. What do we think? Any suggestions on how Jaguar Land Rover, car manufacturer, could lower its break-even output? We're looking for something specific here rather than just saying sell more products, increase its selling price, reduce costs, reduce fixed costs. That's just a vanilla answer. So let's start sticking 1 or 2 on the screen as they come in. You might spot some. I'm just spotting some of the early submissions here. One from Jack there: increase the price of a Land Rover. Foxfire increasing the prices of their cars. Could be a bit more specific there, do you think? I don't know.
Yeah, I think it's how we develop that.
Cheaper producers of aluminium and steel, which is obviously about car manufacturing. Have you spotted any more?
I think there. I think there's a lot there. I think there's a little bit of we've drifted a little, say selling more cars or things like that. Richard Owlett there, getting hold of microchips is very specific fixed costs and things like that. I think should we reveal what we had and we'll just do a little bit of analysis on that and
finding a cheaper supplier for engines and tires. That's a great one from Cameron. Let's see what we went with. What do you think? So JLR could increase the contribution per unit by reducing variable costs, such as negotiating better deals with its engine and semiconductor suppliers or paint for the car bodywork. So that kind of does it, doesn't it, G?
Yeah. So I think just picking that apart a bit, what we're really after at this stage is what we call explaining the hows and the why. So rather than just saying, well, increasing the price of the cars, that doesn't explain to an examiner how that would actually reduce or lower the break-even point. So what we would need is something like increasing the price of their cars, would therefore lead to an increase in contribution per unit. Subsequently, JLR need to sell fewer cars to cover their fixed costs, such as production workers' salaries or rent on the factories. That's what we need. So we really need to explain how and why your suggestion would lead to a reduction in break-even point. And that's the difference between analysis and just stringing together knowledge points with connectives. Okay, that was some very good answers there. Some very good answers. Should we do one more of these?
Let's do one more. So JLR should have disappeared, and it's been replaced by an exam goal dispenser. I don't know what that is. Could it possibly land on that one? I don't know. Let's spin the wheel. Over to you, G. What's it going to be?
Explain how this business could increase its contribution per month. I think it's going to be Sky.
Oh, it is Sky. So a bit more specific, isn't it? This time, contribution per unit. So another level of detail into break even.
Did you see El Clasico on Sky yesterday? Cardiff versus Sunderland. Mighty Red and Whites. Another away in for the boys. So explain how this business could increase its contribution per unit. So we got TV and broadband provider Sky, and actually this is a fantastic example because they've done something really, really sort of. They've streamed the business, if you pardon the pun, which has actually led to an increase in contribution per unit.
What do we think? I'm just putting a few here which are nicely applied in the context of Sky.
That's very good. That the broadcasting rights has really increased the selling price of broadband.
Yeah.
That's very, very, very good. Well done, Hannah. That is brilliant. It wasn't a great win against Hull because we didn't win. Increased selling price by offering ultra fast broadband through. That is dripping with application. That
isn't
is
it?
well done
It's
for
literally
Matt.
per unit.
That is an absolutely an Adam there. Someone can improve the connection of its network. So by increasing the selling price of its products, such as Sky Glass. So we got such as seasoning there. Yeah, well done, Julia. We should pick up Hannah there because it was a great answer. Or the subscription prices of services such as Sky Sports or Sky Atlantic. So those students who've maybe joined us at one of our live Grid Booster events, and we're doing lots more of those after Easter, will be familiar with what we call such as seasoning, and that is using the word such as and adding a contextualized word.
Oh, we've lost G. Don't know where he's gone. Internet's gone, so I'll continue. We'll come back to such as seasoning. Here he comes. He's back.
Oh, did I go off there?
Yeah, just briefly, but you're back. You were halfway through explaining it, such as seasoning.
Yeah, so using the word such as and then using a little contextualized word, anonymous there, a bit of that salt and pepper. Yes, you really do need to assault your answer. And if you look at Sky as an example, they've really reduced their variable costs per unit because they are phasing out the dishes and they're going for the puck. I have myself just invested in one of the Sky pucks. So I stream Sky through a dish. Subsequently, that is a reduction in variable cost per unit, which therefore increases contribution per unit, which means lowers the break-even point. So there were some very, very good answers there, and there were some really good examples of application. Great
So
stuff.
we've got 10 minutes or so left. We'll do some investment appraisal. I think break-even is the biggest one of the two topics here today, but investment appraisal as important. One or two people in the live chat at the start saying they weren't sure or maybe hadn't yet covered it. So it could be one of the topics that's been left until last, but let's assume that most people have covered investment appraisal for the next 10, 15 minutes or so. Let's start with a couple of MCQs. Now, MCQs obviously don't feature in Edexcel, but they're quite a nice way of testing knowledge and understanding. Obviously, for AQA students, if you're doing AQA, some MCQs like this one on the screen. So have a go, whichever board you're doing. So statement one, in an investment appraisal for a project, the payback period ignores cash flows that occur after payback has been achieved. Is that true or false? And statement two, in an investment appraisal for a project, the ARR of the project, one of the three methods there, needs to take account of the initial cost of an investment. Is that true or is that false? What do we think? So some combination of those two. True, 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 false, false, true, false, false. Quite a nice way of just testing understanding of the approaches taken by two of the three methods. Most people going for the same answer, which is A. It is indeed A. Yeah, well done. So don't forget payback. Once payback has been achieved, that's it. You forget all about the cash flows after payback period for that particular measure. And perhaps as we'll see in a few minutes, the ARR does need to take account of the initial cost when you're working out the average annual returns. You can't ignore it. Lots of students do, and sometimes lose some marks. So, G, do you want to do this one? Surprise, surprise. It's an ARR calculation.
Yeah, now average rate return, would you believe, happens to be out of the three methods, payback, average rate return, and NPV or discounted cash flow, is the one that students do often get wrong the most, and it is the most frequently examined method of investment appraisal, would you believe? So it's a good job we're covering it today. So we've got the net cash flows there of an investment, which you can see on screen. That's illustrated by the negative amount in year zero. Can you work out the average rate of return for this investment? So we've got the net cash flows, we've got the cost of the investment. You have everything you need to be able to work out the average rate of return. So just wait, and I'll just do a little bit of freestyling while we're waiting for that. So remember, formula, process, final answer is the way to do it. And I'll give you a little tip on how you can avoid forgetting to deduct the cost of the investment before going on to calculate the average.
I'm hoping that the lads from Lincoln who turn up to our Leeds Grade Booster will get this right. There's no reason why they shouldn't after that session. Looking out for their answers.
So the majority are going for B.
Yeah.
Let's reveal the answer.
Yep.
Okay, let's just quickly run through. Let's ignore the fact that it's in thousands for now. So you just add up the net cash flows to 800, 1,000, 1,700, 3,500. Deduct the cost of the investment. That's your net return. Then divide that by 3 to get your average return. And then you divide that by the cost of the investment again and multiply that by 100. Now, in my experience, in Jim's experience, and our experience, a lot of students do forget to deduct the cost of the investment. So what I always say to students is start off with the cost of the investment as a minus figure in your calculator, then add on the net cash flows. And by the end of it, you've therefore, as if by magic, already deducted the cost of the investment. So put the figure in as a minus, 2,000 as a minus in, then add on the 800, 1,000, 1,700, then you automatically will have deducted the cost of the investment before you go on to work out the average, and then the average rate of return. Now remember, the average rate of return is a good investment appraisal method, as it allows, because it does take into account all the cash flows, also allows you to compare easily. Do you get given the net cash flow in the exam? Now, anonymous, that is a phenomenal question, because the answer to that is no. You don't always get given the net cash flows. You may be given the cash inflows and the cash outflows, and you may need to work out the net cash flows before going on to work out the method of investment appraisal. So remember, net cash flows is simply cash inflows minus cash outflows. And another error that some students make, so on an AQA paper a few years ago, students had to work out payback and net present value. Some students apply the discount factor before going on to work out payback. Remember, you only use the discount factor to work out net present value. So you don't apply the discount factor when you're working out payback, average rate return. And there was also an issue with some students being unsure as to each method of investment appraisal. So some students worked out average rate return when they were asked to work out payback and things like that. Jesse saying, what do you think is the best method of investment appraisal? Well, as a lot of things, it depends. If you're a business that operates maybe in a highly dynamic market and you want a really, and cash flow is an issue, maybe payback, because that focuses on how quickly you're going to get the money back. If the objective of the business is profitability, then maybe the average rate of return. But the best method overall out of the 3 is really the only one that gives a definitive answer is net present value, because that takes into account the time value of money. So therefore, net present value, if it's positive, really you would proceed with that investment, because it means in monetary terms, it's a positive return. So for full marks, do you have to write down the equation? No, if you just got the answer right, you'd get full marks. Absolutely. So if this was a calculation question and you just wrote 25% down, you're going to get full marks. Why we encourage formula process answer is because, say, horror of horrors, you forgot to deduct the cost of the investment, but we could see you'd done that in your working out, you're going to get marks. That's why it's good exam technique to do that. But as long as you get the right answer, that's all we are concerned about. Just one final one I'll pick up by Isabel. Yeah, we will run some specific UK car manufacturing live streams for paper 3. Indeed. Yeah, we will do that. Okay.
Next one, so I'll do this one. So I think we've got a couple more MCQs for investment appraisal. We've got another 10 minutes left. Businesses considering a long-term investment project. That's quite important. A long-term investment project, and decides to use MPV, one of the 3 methods, and payback period, second method, to appraise the project. Management at the business consider the forecasted net cash flows to be highly uncertain. The best way to address this in investment appraisal is what? What would you do? So we've been told it's a long-term project. They want to use MPV and payback, but they're uncertain about the forecast net cash flows. So is it A, do you ignore the net cash flows after year 2? Do you use a lower discount rate and higher discount factors? Do you use a higher discount rate and lower discount factors? Or do you ignore MPV and only use payback? What do you think? Quite a nice sort of little qualitative question here, isn't it? About how do you, it draws on actually something Graham's just been saying about the relative benefits of net present value. What do we think? Most people going for B, I would say. I would say most people are going for B, 1 or 2 A's, 1 or 2 C's. Let's have a look at the answer. It is indeed C. And here's the reason why it's C and not B. So the reason why you use discounted cash flows is that if you're not sure about future cash flows, or if they're more uncertain, they should have less importance, less weight to the evaluation, to the appraisal. Therefore, the way to make those inflows in the future less important is to apply a lower discount factor. So rather than 0.8, you might apply 0.6. And the way you get a lower discount factor is to use a higher discount rate. So that's how MPV works. Those discount factors reflect the percentage discount rate that you use. So if you're not sure about future investments, it could easily be a paper 3 question, say in AQA, and you think it's highly uncertain, one way of reducing the risk of making the wrong decision is to use a higher discount rate, and therefore the discount factors are much lower. They reduce the value of future cash inflows the further you get away from year 1 and 2. That's the reason for that answer. So I think we've got a calculation countdown, and they give me 2G to finish off. Do you want to do this one?
Yeah, okay then. So we've got a calculation countdown, which is a payback question. So again, we've got the net cash flows. You got the initial investment there. You got year 1, year 2, year 3. You got sort of discount factor there. So basically, can you work out the payback period based on the information in the table? You have 60 seconds with which to do it.
Yep. No sound effects for this one, G, due to the earlier technical gremlins, but we can maybe help students out with how to do it.
We can fill the silence. So there was a question there from Ruben. How do you work out the discount factors? Well, you don't need to. You will always be given those in an exam. So you will always be given the discount factors. So don't worry about that. So we've got some answers coming through. So, you know, we're a little bit, yeah, I've seen a couple of correct answers, which is great. So I think by inference that the fact that Jim's putting 1 year 9 months on screen must lead me to believe that the answer is
just picking out some random answers, Graham. 9
months. I would say, you know, there was 50-50 of students getting that right and not getting it correct. Now, I saw students just get 1 year 3 months, and I know why you might get that answer, but if you just wrote 1 year 3 months down, you get no marks. That's why formula, process, answer is so important. So we know after, you know, year 1, £400,000 being repaid, that leaves £600,000. So, you know, payback must occur. You know, just after that, the net cash flows in year 2 is 800,000. So the 600,000 divided by the 800,000 times 12 is 9 months. So payback is 1 year and 9 months. Another way of doing that would be just to divide the 800 or 800,000 divided by 12, which would give you the net cash flows per month, then divide that into 600,000. I would personally avoid that because it's an extra step in the calculation. And a good question there for Matt there. Do you not do anything with the discount factor? Not at all. That was put in there to sort of not trick you, but some students would apply, as I mentioned earlier, the discount factor before going on to work payback. So you only use the discount factor. You only use the discount factor when doing net present value stroke discounted cash flows. So if the discount factor is there and you're asked to calculate payback or average rate return, completely ignore the discount factor. You only use it for net present value. Now, you can convert it to weeks, but there's no need. You will always be given the marks in months. Trying to convert it after the weeks is messy. Keep it, I mean, or, you know, but if you wrote it in weeks, you just, you know, you can do that. That's fine. But just put it as months. There's no need to reconvert it. So, yeah, I think well done.
Right. We've got one activity left. Well, we'll do this together, shall we, Graham? So, again, not particularly picking the car industry every session, but it's really useful for Edexcel students in particular, who are looking at that sector as part of their paper 3 synoptic paper. And this is a case study of business that's well worth knowing a little bit about. So in 2021, Jaguar Land Rover, or JLR, announced plans to invest $2.5 billion per year for a long time into electrification and related technologies. And the Land Rover range, I think, is one of the first in the range to get its first fully electric model sometime next year. So they're using investment appraisal. So the last question for Graham and I is, in the live chat, can you give us a benefit, or even give us two benefits to Jaguar Land Rover of using investment appraisal before deciding whether to proceed with this investment? So what are the qualitative benefits here of investment appraisal? Let's start the little clock there. Imagine the bongo music and the guitar playing in the background. What do we think? Any thoughts in the live chat? Maybe give me or Graham a benefit to Jaguar of using investment appraisal. Ideally, applying it maybe in the context of that mini case study there, this electrification, the move to electric vehicles. If you spot any answers, G, in the live chat you want me to put on, just shout them out. I'll pick out one or two. Edward's come in with quite a detailed one there. Can decide whether the investment is worth it. That's what investment appraisal is there for. See how long it would take to pay back the, perhaps by having an increased reputation for having a fully electrified range. What else have we got here? Just try and pick out one or two that are in context here. What do we think? Let's have a look.
Yeah, there's lots of good ones in. Yeah, obviously reducing risk. See when you start to make a profit. Yeah.
Yeah, it's a good one from Roshni talking about cash flow. It's true, actually. By using investment appraisal, you have to, by definition, produce a cash flow for the project, don't you? And therefore, a consequence of using that is that you can work out what the cash flow implications are of this massive investment, and when does the cash flow arise, and who gets the cash flows. So definitely worth doing that. Any more that you've spotted?
Yeah, I think there's someone mentioning about the thing is, obviously with ARR gives a percentage, and you can, and students will often go down the line of, well, you know, you can compare that with the bank's rate of interest, and maybe better off putting the money in the bank. And that's a fair point, to be fair, in certain businesses. But in the case of Jaguar Land Rover, I mean, they have to move to electric vehicles, so they're not going to just be able to put the money in the bank. Yeah, that is good. It is a risky investment. Yeah, it is good. Yeah, so there is some really good application there. There is some really good application. I just wanted to pick up something that I saw earlier related to payback, if I just may, just before you reveal the answer, about do you round up if it came, say it was 1 year, 9.5 months? No, you don't. It's not break even, because those 0.5 months, are a set number of days. So you don't round payback up at all.
Oops. Let's go back. There's a couple of benefits that we thought of. I think a couple of people in the live chat mentioned this issue about cash flow forecasting. If you do an investment appraisal, you need net cash flows, don't you? So you need them for net present value, you need them for payback, and actually you use the same information by and large for ARR. So actually the process of working out the cash flows, which would be quite complex for a big project like this, a risky project like this, and a long-term project like this for JLR would be means that investment appraisal is a really important process to go through. And I think also it's that it's coming back to that financial point you mentioned, Graham, isn't it? Tata Motors know they need to invest, but is the way that they're structuring the project going to give them the right kind of return? If not, what could they do to improve the return, knowing that they have to do it? But what do the returns look like?
Yeah, in our live workshops, in our cinema workshops for Edexcel, we talk about Aston Martin and Lotus. We do Aston Martin as well, but Lotus need 2 billion to move to electric vehicles, and they are considering stock market flotation. So if you think about that, they're inviting people to invest or buy shares in order to fund their move to electric vehicles. So investment appraisal in that context would really help sell that as an investment. You know, if they can turn around and say, well, actually, our move to electric vehicles will produce an average rate return of this, then that might help sell, you know, maybe more shares to investors. So it's about looking at the business you're writing about in a holistic way and saying, can I hook, you know, my answer into the specifics about that business? So that's just a really good example there of
Yeah.
how Lotus might use investment appraisal as part of their stock market flotation.
Superb. Right, there we go. We've done 40 minutes, 10 minutes, 10 bonus minutes. Well, it would have been about 8 bonus minutes without the technical gremlins at the start. So we've covered two
Yeah,
really
that's part of
important
our
concepts there: break even and investment appraisal. Two absolutely crucial topics for the summer exams, I reckon.
definitely. And I would, you know, investment appraisal did come up for Edexcel in the summer. It was a part of paper 3 last summer, sorry. That's not to say it couldn't come up again. Investment appraisal did not come up last year for AQA, one of the first years it hadn't. Now, you know, predicting questions is a fool's game, and we would never do it. But investment appraisal, you know, hasn't appeared last year for AQA, so I would make sure in Edexcel students, just because it came up in the past, don't be seduced by that and think, hold on a second, that came up last year, it won't come up again. Exams don't work like that.
Yeah,
It could
cool.
equally come up once more.
Yeah, too right. Excellent stuff. Right. Well, thanks, Graham. Thanks for joining me. Now, tomorrow we're doing we're moving to what I've called people and resource management. So basically, so a combination of HR management, but also resource management, things like capacity utilization, lean production, that kind of stuff. And then I think on Thursday we're doing some financial ratio stuff, followed by an external environment session, interest rates, inflation, exchange rates, that kind of stuff on Friday. So if you can join us again tomorrow at 11 for another A-level business session, that'd be cool. If not, don't forget you can always catch up with all of these sessions by going to tutoru.net/live. And hopefully we'll catch you tomorrow morning. But for now, G, thanks for joining me, mate. I'll catch you in the morning.
You're welcome.
Cheers, everybody.